calm down before you stress up the groove. The energy a little different when the blessings accrue.
Hey everyone, welcome back. So last episode we were talking about your employee stock options and trying to figure out what they're worth. This week we're going to continue that conversation and talk about how they could be worth a lot. You know, if there's one thing that you need to learn around this whole topic, it's that the value of something you own is worth what somebody else will pay to buy it from you. Let me give you a simple analogy. Let's say, for example, you have a 1960s collection of Barbie dolls and you've done all the research, you've done years worth of research, you've talked to all the experts, and they say your collection is worth 10 grand. And so you decide to sell it, you spend a year trying to sell it, and at the end of the year, the highest bidder will pay $500. Now, what's the takeaway from this? The takeaway is 1960s Barbies are priceless, and shame on me for trying to sell them. So in the last episode, we started the conversation around what your stock options could be worth. And we talked a lot about the basics and a lot about things that can go wrong that would cause your options to have little or no value. And normally I would say, if you haven't watched that episode, stop everything and go back and watch it. And I'd include a link right up here, but I'm not going to do that this time. And the reason is because today's topic is just way more exciting. So I want you to stay in the moment and enjoy the excitement. Now that said, when we finish this one, if you haven't watched episode 1, make sure you go back and watch it because I do want to make sure you understand the basics as well. So as a quick refresher from the last episode, we talked about things that need to happen in order for you to realize value from your options. And we talked about how this tends to culminate around an exit event, which is when your company is either bought by another company or your company goes public. Now, before we get into the kind of the deep dive around the exciting part of how you make real money, I want to take a moment to just do a quick quiz, one question quiz, where we kind of test your baseline knowledge on this subject. So here we go. What is the most important factor in determining the ultimate value of your options upon an exit? Is it A, the percentage of the company you own, B, the market price at which someone will buy your shares, C, the strike price of your grant, D, the number of options in your grant, E, all of the above, F, B, C, and D only? What do you think? The answer is F, which is B, C, and D only, and here's why. As we learned from the last episode, the equation for figuring out the value of your options is to start with the purchase price from the buyer, which I'll call the market price. You subtract the strike price from that, and then you take the difference of those two numbers and you multiply it by the number of options you own. These are the only three variables that matter unless you factor in taxes, and we're not going to cover that this time. You know what I find really interesting about this simple equation? How many people ignore it when they're trying to figure out the value of their options? Let's say when they're negotiating their offer to join a new company. They just look at one variable. Now, having just one variable is meaningless. It gives you an incomplete picture. It's like if I told you, hey, I just completed a race in 28 minutes. Is that good or bad? I don't know. Was it a 5K or 10K? By the way, was it a foot race or a bike race or some other kind of race? If you don't look at all three variables, you really have no idea what the value is. So you know what else is interesting about this equation? The percentage of the company you own is not one of the variables, and yet that's one of the few things people tend to focus on when they're negotiating a job offer to join a new startup. The only thing percent ownership tells you is how your ownership compares to all the other shareholders combined. Now, it could be helpful in helping you determine if what you're getting as an option grant is equal to something somebody else is getting in a similar role, although you could still ask that exact same question, asking for the number of options versus a percentage of the company. So I'd encourage you not to overly focus on your percent ownership because it's not relevant to the actual value of the options you were granted. You're still going to focus on it, aren't you? So at this point, you're probably thinking, Moody, this equation could not be more simple. I already know how many options I was granted. I already know the strike price. When somebody buys us, I'll know the market price, and then I'll do the simple math, and I'll know what my option grant was worth. So this seems really simple. Like, why don't we just wrap up this video and call it a day? And to that, I say,
not so fast, my friend.
So going back to the equation, yes, the number of options is a known quantity. It might increase over time if you get more grants, but there's no mystery around this variable. Just don't forget that only vested options get to be plugged into the formula, which is a topic I covered in the prior episode. For now, let's start with the example where you have 10,000 vested options, and let's plug that into the formula. So you might be thinking, hey, what about that market price? We're probably not going to be able to plug in a number for that until there's an exit event, like the company goes public or somebody else purchases the company. And that may be true, but if your company has already raised money from investors, whether it's angel investors or institutional investors like VCs like myself, then actually there has already been a market price established. You see, when investors are investing in a company, they're trying to get some ownership in that company, and they're going to receive stock, and they're going to receive stock at a certain price. So how much stock they receive and at what price they pay is determined by deciding what the value of the company is. And how did they decide what the company was worth? Well, they negotiated with the founders, and they went back and forth, and they landed on a number, and they said, the company is worth X, and so you want to own 10% of the company, so it'll cost you Y. This is super important because it means that somebody has already decided what they'll pay for something that you own, which brings us back to that Barbie doll analogy we started with in the intro. Remember, we thought the Barbie dolls were worth $10,000, but after shopping them for a year, we found the highest bidder was $500. Now, the fact that somebody will pay $500, indisputable, that's what they're worth to you. Well, that's the same thing. Investors, indisputable. They've already said they believe the company's worth X, and they've been willing to pay Y on stock to own it. So that's really, really strong signal into what your options could ultimately be worth. So if you don't know information around the last time the company raised money and the dynamics around that raise, you need to find that out, whether it's a company you already work for or your company you're considering joining. So there's a very specific question I want you to go ask, which is, what was the last round's preferred share price, and when did that happen? I'll explain the specifics around what that question actually means in just a second. But for now, let's go back to our formula, and let's say the answer you hear back when you ask that question is the last raise was done at $3 per share. That was the preferred price, and it was done 11 months ago. So now we know someone was actually willing to pay $3 per share. That's highly relevant. And we also know it was a while ago. It was 11 months ago. And that's a long time in startup life. So now that we have this data, I want you to consider a couple of other things. First of all, I think it's important for you to start digging in to say what's happened with the company since that last price was established. So in this case, 11 months ago. Now, if the company has grown substantially, the fair market value might be much higher than $3 now. Again, that was a price that was set 11 months ago. If the company has doubled in size over that period, then who knows? The current market value might be closer to $6 or $10. So understanding what's happened is really important. By the way, if the company's completely stalled, the number might have gone down too. But understanding the timing, because that $3 was a moment in time, and time keeps ticking on, and the company keeps progressing or digressing. So you need to understand what's happened. The second thing I want you to remember is that investors bought at $3 a share, but they're investors. They're anticipating that the price will go up. So what did they think the price would ultimately land in by the time they're able to sell their shares? Well, if they're an early stage investor, like a seed stage investor, maybe a Series A investor, they're probably anticipating that that price will increase by at least 10x. They need a big outcome if you're an early stage investor. So that would mean that the price might ultimately be worth $30 in their mind. Now, investors at a later stage, they're probably thinking more like 3 to 5x. So in this example, they may think that the fair market value is going to be closer to $9 or $15. We don't really know, but the important thing to remember is that the investors are planning for a big outcome here. They're not planning for this company to sell at $3 per share. So if an investor thinks this thing's going to go from $3 to $30, can we trust that? Absolutely not. But it is helpful and informative to know that perhaps an experienced investor who sees lots of companies and does lots of deals thinks this thing has massive upside potential from a $3 to $30 type move. That's a nice signal for you. Now, at this point, you might want to dig into the quality of the investors and the experience of the investors. But again, I'll save that for another topic. Okay, so let's look at this last component of the formula, which is the strike price. The strike price is the price you'll pay to convert your options to shares. Again, I talked about that a bunch in the last episode. given it's the price you're buying the stock at, we want it to be low. So how does the strike price get determined? So the strike price for a privately held company gets set by a third-party appraiser through a process called a 409A valuation. Now, this dates back to like 2001 and the Enron crisis, when the IRS was looking to start to crack down on all these loopholes, especially for executives around option grants. So they came up with a new tax code 409A, in which they said the value of your options are going to be determined by a third party, not by the executives at the company, through this 409A valuation process. Now, the company's value is going to constantly be changing, so your startup probably goes through a regular cadence on when they get these 409A valuations done. And the faster the company's changing, the more frequently they're getting them done. But I'd say, most companies are maybe on a once a year or once or twice a year schedule to get a 409A valuation done. Important thing to remember is that you also have to get a 409A done if there's a material event that could impact the value of the company. So if your company's in process of raising money, then the board can't issue any new option grants at a new strike price until that 409A is complete. Now, this is super interesting if you're considering joining a new company and then they're in the middle of raising money, then they're going to be able to tell you how many option grants you're going to get when you join, but they're not going to be able to tell you the strike price until the raise is complete. Now, don't let this freak you out too much, but you should start asking lots of questions around, well, what's the expected increase in value of what the new investors are going to pay versus the last round? And then what was the strike price the last round? And then you can do some relative math to figure out where the strike price might land. It won't be exact science, but it should give you some comfort around where your strike price might land. So one thing I just want to briefly mention is that the strike price is a strong signal around what the price of common stock might be worth. And common stock is what you'll be purchasing when you ultimately exercise your options. Now, common stock may not sound like an impressive thing, but understand that common stock is very likely what your CEO has and also what the rest of the executive team has. The difference is that when investors invest, they're typically being issued preferred shares. And their preferred shares, they probably paid more for than the common price because those preferred shares came with some extra rights, some extra voting rights, and also maybe came with some more favorable economics. Now, you might think, well, this stinks. I am holding something that's less valuable than what the investors held. But actually, that can work to your advantage, and I'll explain that dynamic through an example. Let's say your company goes out and raises money and the valuation they raise at is $100 million. Well, that $100 million helps set the price per share of the new preferred stock that was issued to the investors that invested at $100 million. Now, for the sake of this example, let's go back and assume that ended up being $3 per share for the new preferred stock that was issued. Then the question is, what's the strike price? And the answer is it going to be $3 a share? After all, the company was just valued at $3 per share. And the answer is no, because remember, the strike price was set by not the price preferred, but this 409A valuation process. So once companies raise money, they'll do a new 409A, there'll be a new strike price. And here's the good news. The 409A valuation is almost always substantially less than the preferred price that was just set through a raise. And right now, I'd say the most common discount I'm seeing right after a raise is somewhere between, say, 55% and 70% discount off of the preferred price. So what does that mean? That means that you're getting a massive discount. Somebody just paid $3 per share, but if you're getting a 70% discount, that means your strike price would only be 90 cents per share. That's pretty cool. Somebody just paid $3 and you're getting the same thing almost for 90 cents. That leads to the question of like, yeah, I get it. I get the delta, but you said, Chris, preferred is worth more. So help me understand those dynamics. Is there a difference? Well, the first thing you should know is that the $3 was set by, say, a VC. And VCs are very optimistic. They're wanting a big return. They tend to look mostly at the upside. If things go well, how much could this company be worth? And then that's how they help set their price for the valuation. 409A, which is done by financial people looking at very standard financial models like discounted cash flow. They're often looking at public market comps. They will come up with the best formula to determine value, but they often are looking at the risk side of things. And they are also recognizing that the stock you're getting doesn't have some of those rights and privileges that preferred got. And so they issue a discount. And again, typical discount I'm seeing right after a company has raised money is somewhere between 55 and 70%. So I think this is a really healthy and informative, maybe one of the most informative ways to think about the value of your options is to think about that strike price as a discount and ask yourself, how much of a discount am I getting versus what somebody else has already paid? Somebody else already set the value for the company and I'm getting that at a discount. What's the discount actually add up to? All right, so the last thing we're going to touch on briefly is this whole difference between preferred and common, because you're thinking, yeah, I'm getting a discount, but I'm getting common, and that's not as valuable as preferred, because preferred comes with these extra control rights, and maybe it also comes with some economic advantages. I can tell you that in the case where your company is exiting, and it's a good exit, meaning the investors are getting a nice return on their investment, there is no difference at all. In fact, what investors will do in that scenario in most cases is they'll actually take their preferred shares and convert them to common. And that conversion is a 1-for-1 share. So every share of preferred, they'll get 1 share of common. So they're actually recognizing that their shares are worth exactly the same as your shares in that very moment. So that's the case in a good outcome. And in the case where there's a bad outcome, then definitely the investors get some privileges that you don't get. But we're talking about the upside in this episode. We're talking about how much your options could be worth. So in this case, common and preferred ultimately could end up being the exact same. And you're just really getting a nice discount over something that the investors paid much more to own. Okay, what does all this mean mathematically? Well, let's go back to the example earlier. Let's say you had those 10,000 fully vested options and they were issued at a strike price of 90 cents. Which again is a nice discount because the market value was set at $3 per share. But let's also remember that market value in our example was set 11 months ago. So we need to figure out what's happened to the company in the last 11 months. Now, let's say the company has actually grown a lot. Then perhaps that market value is now closer to $6 instead of $3 per share. So you just got shares issued at 90 cents because there hasn't been a new 409A valuation, but the company's now might be worth $6 a share. Well, you can see that makes a big difference in the number in the math. Well, by the way, the company might also be valued at $10 per share now. So now that delta, which people refer to as the spread between the fair market value and your strike price, is getting bigger and bigger, and that has a huge impact on the ultimate value of your options. Also, just remember that even though the fair market value right now was last set at $3 per share, investors think if they were early stage investors, say seed stage investors or Series A investors, they might think this thing's ultimately going to be worth $30 a share. Now you can see this math is getting really interesting. Okay, so what do we take away from all of this? Well, if we want to figure out what our options might be worth, and we want to figure that out now instead of waiting till the end of the game when there's an actual buyer at the table, then there's some things that we have to factor in and we need to know. First of all, we need to know if the company's already raised money, and if it has already raised money, what did investors pay to get ownership in the company? Because that's really important signal. Again, that signal that somebody was willing to buy something you own at a certain price. We also want to know how long ago that was, and if it was more than, say, 6 months ago, we want to really look and say, what's happened to the company in the last 6 months? Has it increased in value or has it decreased in value? The second thing we want to look at is our strike price, and here we're really looking at the difference between the market price and the strike price and saying, how big of a discount am I getting, and should I feel good about that discount? That's a really important number for you. And then the third thing that you want to look at is you might want to consider the quality of the investors. So these people that invested at this last round, Are they credible investors? Do they do lots of investments? Have they had lots of success? And also, what type of investor are they? Are they a seed stage investor? Are they a Series A investor? If they're a seed stage investor or Series A, they might have very high expectations. Maybe they want a 10x type return. If they're a later stage investor, they might want more like a 3x return. But that'll give you some signal about what the stock could be worth based on other people's opinions, whether they're experts or not. Okay, that's it for this topic. I was thinking, by the way, for the next topic, I might do just a quickie, which is like, here's the top 5 questions I would ask about my options if I were working at a company or if I were joining a company. And I'd probably cover some things that we haven't touched on in these first 2 episodes yet. So let me know in the comments down below if that's something you'd like for me to cover. Also, speaking of comments, if you haven't already liked this, please like this video. If you haven't already subscribed to the channel, please do so. And again, keep the dialogue going down below in the comments. I'd love to hear what you have to say and if you have any questions about anything we've covered so far. Okay, that's it. I'll see you on the next episode.